Hello and welcome. I'm Steve Bennett, CEO of the Direct Business here at Charter Hall. Today I'm joined by Ben Ellis, who is the CEO of Charter Hall's retail division. We're going to discuss the convenience retail sector, as well as an exclusive opportunity for high net worth investors with the launch of the Charter Hall Direct Convenience Retail Fund, or DCRF for short. Thanks for joining us, Ben.
Thanks, Steve.
But before we start, a reminder that this information should not be taken as financial advice, and investors should always consult a financial advisor if you have queries that relate to your own personal investment situation. We also always encourage you to read the relevant offer document, paying particular attention to the risks. So I think a good place to start is to clarify exactly what the convenience retail property sector is, and how does it differ from the other forms of retail like your big shopping malls that many investors are familiar with?
It's a great question, Steve, and obviously convenience retail is at the cornerstone of what Charter Hall does in the retail sector. So when you think about convenience retail, think about the places that you go and buy your groceries every day. Coles, Woolworths anchor all of our shopping centres. Our typical tenants include pharmacies and doctors and greengrocers and butchers and bakers, and it's really where everyday life is created through the provision of goods and services to service those communities.
Okay, Ben, so let's just get into a little bit more detail. What would you say is the difference between non-discretionary and discretionary retail?
So non-discretionary is a type of retail that we specialise in. Non-discretionary retail, once again, goes back to everyday needs and services that are essential for daily lives. We don't play in areas of discretionary retail like fashion and jewellery and homewares. We focus on things like goods and services that the communities need to operate and live every single day of their lives.
And does that mean that they're more defensive than some of those other areas that you just called out?
That's right, Steve. So non-discretionary retail services and goods are areas that are resilient regardless of economic cycle. So regardless of whether the economy is going well or poorly, people still have to buy their groceries. They still have to go and see a doctor. So these are sort of the type of retailers that we focus on because of their reliability, stability, and ongoing rental growth that can be provided through those areas.
And I guess when we're pulling together a new product at Charter Hall, what we look for is that defensive characteristics, tenants that can go through cycles, cash flows that are regular, stable and growing. And it sounds like with convenience retail, you get that much greater stability of cash flows than you can with some of those other tenants.
Yeah, if you look through over the last 40 years, the number one growth trajectory for any retail tenant has been groceries. So that's the cornerstone of what we do, underpinned by the strong tenant covenants of Coles and Woolworths, supported by Aldi, and really focusing on everyday needs for the local communities we operate in.
So at Charter Hall, we like all the core real estate sectors. Strong tenants, institutional quality, that's a given. Maybe, Ben, what's your perspective on how this part of the property sector differs from, say, office and industrial and logistics?
Convenience retail, as we talked about, are really focused on local communities. The options for tenants to move into other locations aren't as prevalent as they would be in, say, industrial and office, where they're generic asset classes and obviously a big tenant bank. These are individual assets that are focused on local communities. So think about the fact that Coles and Woolworths operate supermarkets in one catchment. They don't operate 3 or 4. So you have a lot of security of tenure and a lot of security in terms of locational attributes. So zoning, planning, and these types of things are very important to the convenience retail sector. It's also important because the nature of convenience retail offers a very high cash flow. So we don't have lots of incentives, we don't have downtime, we don't spend lots of capex. So the underpinning feature of convenience retail is high effective yield and high effective yield growth because of that underlying retail tenant base we have.
And that all feeds into good, stable, and at this point in the cycle, quite elevated total returns.
Yeah, it's a great point in the cycle. So through all of our major property cycles, we see various asset classes come out first, and we feel that convenience retail is going to be one of the first ones to come through the cycle, and we're starting to see evidence of valuation growth. So right now, we feel it's a great time in the cycle to be investing in convenience retail.
So Charter Hall's raised $1.8 billion from institutional investors globally and domestically. Why are those investors looking at convenience retail right now?
So, Steve, convenience retail is a unique asset class. Traditionally, large institutional investors have invested in large malls. That's discretionary retail. And as we discussed, they like the emphasis on non-discretionary retail. They like the security of it. They like the resilient cash flows and the high income yield the sector produces. Additionally, it's a large opportunity. Convenience retail is one of the least commercially owned subsectors of real estate in Australia, And we think that's an opportunity for us to set a new fund in place to attract excellent groups of capital and to grow a resilient and growing income stream for investors.
And even I'd add for our high net wealth investors, often this kind of product's only available in one or two asset small syndicates, whereas you and the team have put together, I think you're targeting a $3 billion portfolio. So I guess there's scale and that diversification.
Yeah, that's right. So diversification of locations, diversification in terms of lots of assets. It's a very liquid market, so we're able to buy and sell assets quite freely through all economic cycles because of the large investor base that likes this asset class. And importantly for us, it really offers a differentiator to our investors.
What do you think some of the key factors are going to drive that sector, not just now, but over the next 5 or 6 years?
It's obviously a very resilient sector, Steve, as we talked about. But fundamentally, Australia's got really strong population growth. That population growth is going to be very much focused on capital cities, metropolitan locations, where all of our shopping centres are located. As the population densifies, it means retail sales will accelerate, which means rent growth will remain strong and resilient over long periods of time. Coupled with the fact that construction costs are high and land availability is low, meaning supply for the retail sector is going to be limited. These are two really important factors that are going to drive superior growth for convenience retail in the next number of years.
And so for high quality existing assets that have been built, I think that should drive good returns from both cash flow and valuations over time.
Absolutely agree. And as we said, a low point in the cycle, opportunities to invest at that point in time is paramount to returns. But equally, the resilience of income growth are always going to underpin valuation growth and obviously total return to our investors.
So thanks for joining me today, Ben. And for investors who may be wondering how they can access the convenience retail sector, the Charter Hall Direct Convenience Retail Fund is now open to wholesale investors. DCRF for short is an open-ended unlisted property fund providing our high net wealth investors access to that same defensive portfolio of high-quality, non-discretionary, convenience-based retail. The fund provides investors the opportunity to co-invest alongside nearly $2 billion of institutional domestic and offshore equity, and it has a target portfolio of over $3 billion. DCRF offers an attractive entry point to the convenience retail sector at a strategically opportune time in the market and property cycle. It has income strength and its resilience is underpinned by quality tenants and provides exposure to some of Australia's leading retail brands such as Woolworths and Coles, which Ben talked about earlier. The fund has a target IRR of 11% per annum and targets over 80% of the portfolio to that non-discretionary retailer base and in excess of 80% targeted weighting to Australian Eastern Seaboard markets. For more information, visit the fund website at www.charterhall.com.au/DCRF or contact a member of the team.